Good afternoon. Today is Thursday afternoon, February 23rd. I'm Joe Terril, president of Terril and Company, independent wealth managers in St. Louis, Missouri, with approximately $720 million in assets under management. We will be updating our thoughts on economies around the world, economy in the United States, and the outlook for investment markets. We thank you for joining us. As always, Brian Curtis will be helping me. Brian, let's move on to talking about world economies. World economies are improving. Europe is slowly showing signs of positive economic growth. That's beginning to accelerate a little bit. In spite of the political uncertainties going on, we are confident that European economy will continue to grow. Britain is doing well. No Brexit-related disasters of any kind even showing any appearance of happening there. China continues to grow at a very nice pace. It's not the boom that it once was, but then again the economy is 10 times the size it used to be, but the economy is growing at 4 or 5%. There's no banking crisis or any of the things that sometimes people bring up about the Chinese economy. India is doing well after somewhat of a stumble with their currency moves that they did. And as we look around the world, we see economies beginning to pick up, particularly in the United States, where we've been enjoying 1.5–2% growth. We think that growth is going to accelerate to the 3% plus area. This is not a political comment. This was occurring and began occurring before the election ever took place. And this is more predicated upon the easy money that's been created all over the world by central bankers. And it is beginning to have an effect. Along with that easy money, inflation's beginning to pick up. So we'll switch and start talking about investment markets and what our outlooks are there that's predicated upon what's happening around the world and the world economy. Let's move to investments, Brian. Investment markets have been performing very well in the last 3 months. But this is true all over the world. Some of the foreign markets have performed even better than the United States market. So again, it's our contention that although the new president were in favor of some of the proposals he's talking about, some of them we're not in favor of, it's not just a Donald Trump rally in investment markets. We wouldn't see the market up in other areas of the world. It has nothing to do with Trump. So we think interest rates are moving higher. That would argue that you want nothing to do with any type of longer term fixed income investment, aka bond. We are keeping bond maturities as short as we possibly can, and we also have floating rate issues, so not to be locked into anything while interest rates are at a 250-year low. Our average duration is less than a year. We're very confident you're going to see interest rates around the world begin to go up. They haven't moved as much in Europe because there is political uncertainty, and you do have people worried about what the election's going to be in France, what the election in the future is going to be in Germany, and therefore there is a lot of money very cautious there that's staying in bonds and or investing in the United States. There's pretty good thought that our 10-year government bond in the United States that's up in yield from a 1.5 to 2.4 would probably even be higher now if it wasn't for quite a bit of buying coming out of Europe that is money worried about what maybe the potential elections might bring in Europe later this summer. Regardless of all that, we are negative on bonds, very confident you'll see higher interest rates in the United States and around the world in the next 18 months. That leads to equity prices. Stock prices are going to hit a ceiling soon when the interest rates go up. Stocks have enjoyed a spectacular run from, well, let's just say in the last 7 to 8 years, because there was no alternative. Interest rates were zero, negative, many places outside the United States. So a lot of money flowed into U.S. stocks because there was no alternative. In the next 18 months, an alternative is going to develop, and therefore a person should be very cautious about what they're doing with equities right now. We don't see the market moving up significantly higher from where it's at right now. With that said, we still like the financial stocks selectively. We are trimming our positions here with prices at all-time record highs, but for the most part, we still like that sector, and we're going to continue to hold issues. We very much like the energy sector. We think oil prices have bottomed. We look for them to hold somewhere between the $50 and $60 range, which is good enough for particularly the energy infrastructure companies to make very nice money. Production is going onshore in the United States, and that also helps those energy infrastructure companies. We like biotech and pharmaceutical stocks. We like materials, mainly the agricultural area. But in general, we think it's a great time with prices at all-time record highs to be very cautious about your buying and try and be selected sellers. So that's our thoughts for today, and Brian will wrap it up. Brian, thanks for your help this afternoon. Once again, my name is Joe Terril. I'm president of Terril & Company in St. Louis, Missouri, independent wealth managers with about $720 million of assets under management. And we thank you for tuning in today, and we'll be back hopefully in the next 30 days with an update. Thank you.